There's one rule that institutional investors, financial advisors, and every investing textbook has taught for decades, and it quietly stopped working in the way it was designed to, with real money and real portfolios. And there are 7 rules worth knowing. I'm going through all of them today with a verdict on each one. Okay, so the first one is called the rule of 72. This is the most useful formula I know for turning a percentage into something real. Divide 72 by your annual return, and the result is approximately how many years it takes your money to double. At 6%, 12 years, at 8%, 9 years. And that difference of 3 years over the course of a full investing life is significant. The rule works in reverse as well. Divide 72 by your debt interest rate and you get how quickly that debt doubles if you leave it. At a typical credit card rate of say 20% under 4 years, and on inflation as well at 2.5%, the purchasing power of cash sitting unused roughly halves in 29 years, and that number tends to reframe the cost of waiting. The next rule is called the emergency fund. Before any investment conversation, 3 to 6 months of essential spending needs to sit in an easy access cash account, not invested, not tied up, accessible. If you are self-employed or your income varies, that figure moves to 9 to 12 months. This is the foundation. Everything else is built on top of it. Moving on to the next one, which is called 50, 30, and 20. A budgeting framework, not a hard law. Split take-home pay 3 ways: 50% to essentials, 30% to lifestyle, and 20% to savings, investments, and debt repayment. If your essentials run above 50%, which is a reality for many people right now, reduce the 30% before you touch the 20%. The saving and investing rate is the one you protect. Moving on to the next one, which is called the rule of 100. This shapes your portfolio's risk level based on your age. Take 100, subtract your age, and that's the percentage to hold in equities. The rest in low risk assets like bonds or cash. A 35-year-old, 65% equities. A 60-year-old, 40% equities. Most advisors now use 110 or 120 as the starting figure, not 100. Life expectancy is longer, retirement costs are higher, and you need your money to grow for longer. And if you are in a wealth building phase rather than wealth preservation, 110 or 120 minus your age is the more relevant starting point. Rule number 5 is called the 4% rule, and this one is specifically about retirement. Research originating in the US suggests that withdrawing 4% of your investment portfolio per year in retirement, adjusted for inflation, carries a low probability of running out of money over a 30-year period. That research is US based, so treat it as guidance for UK planning rather than a precise guarantee. But as a planning tool, it's genuinely useful. It tells you how large your portfolio needs to be for a given retirement income. If you need 20,000 a year, that points to a $500,000 portfolio, 30,000 per year, 750,000 portfolio, and a 40K per year, a 1 million portfolio. And most people have never worked backwards from a retirement income figure to a portfolio target. And that rule makes that calculation simple. The next one is called the rule of 20. And this one is used to assess whether the stock market is fairly valued at any given point. Take the market's price to earning ratio, which measures how much investors are paying for each pound of company earnings, and add it to the current inflation rate. If that result is around 20, the market is considered fairly valued. Below 20, that suggests potential undervaluation. And above 20 suggests the market may be pricing in a lot for future growth already. It is a starting point for context, not a precise signal. Professional investors use that metric alongside other indicators, never in isolation. Moving on to the final rule, which is called the 60-40 portfolio. And this is the rule I mentioned at the start. For decades, a portfolio split of 60% equities and 40% bonds was the standard institutional starting point. The logic was sound. When equity markets fell, bond prices typically rose, cushioning the loss. The two assets moved in the opposite directions, and that inverse relationship was the whole point of the split. That relationship weakened significantly in 2022 as interest rates rose sharply. Both equities and bonds fell at the same time. A traditional 60-40% portfolio lost value from both sides simultaneously. The rule has not become useless. As a starting framework for understanding risk and diversification, it has value. But as a complete strategy, it needs broadening because most professional portfolios today look beyond equities and bonds to find the right diversification the 60-40 was designed to provide into property, commodities, and alternative assets. Okay, so to conclude, 7 rules, 6 of them hold up, some with some updates, and one needs rethinking as a standalone strategy. What all of them share, they exist because of specific conditions. And when those conditions change, the rules have to change with them. And that's not a flaw in the rules. That's how finance actually works. Next, I'm going to show you what happens when you go beyond these rules entirely. How institutional investors actually build and protect wealth at scale. The frameworks they use are not on the list. Subscribe if you want that one. I'll see you next time.